Mike the Mortgage Guy, coming to you live from Mill Ave. Little different series today. We're kind of walking around my old stomping grounds, Arizona State. Had me thinking, what would I have done differently to prepare myself for home ownership when I was in college? Came up with a few things. I want to go over them with you guys. First things first, definitely would have started saving for a down payment. I know that's easier said than done when you're in college, don't got a lot of money to save, but I tried to break it down as simple as possible. If I were to put away $50 a week when I was in college, $50 a week, 4 years of college, that's $2,600. You have $10,500 for a down payment by the time you're done with college. That's a great start on a down payment. That's the first thing. Number two, I really started working on my credit. I was always kind of crazy about my credit score, always super OCD about that, but super important. Don't get overbeared with student loans. Don't start putting too much on your credit cards. You really want to make sure your debt is as low as possible when you're ready to purchase a home. Yeah, the third thing I would have done kind of ties in to that debt. See, and we're walking by these college kids here. It's a lot harder to save money.
Should we interview him?
A lot harder to save money.
Let's talk to him. See what he's got to say.
All right, you're in. You in school? You in college?
I just graduated.
You just graduated. All right, okay. So I'm in the mortgage business, and we're talking about what I would have done differently when I was in college to start saving up to buy a home. Have you thought about purchasing a home? Have you even started? Okay. Are you getting yourself prepared to buy a home?
Yeah.
Okay, what are you doing?
Okay, so this TMI, but my dad passed away.
Okay.
The sum of the money that he left over is in a money market account.
Yes.
Putting that away. I live with roommates right now. I cannot stress that enough, though. When you're young,
Yep.
live with your boys as long as you can. Save your money,
Yep.
and then just do it.
Yes.
Start paying your mortgage. In the long run, you'll have that crib. You can even make money off of it later if you wanted when it's all paid off.
And how old are you?
25.
This guy's 25 years old. He's wiser than most of the 30, 40-year-olds that I chat with. This guy's ready. What's your name?
Austin.
Austin. Nice to meet you, brother. Good luck, dude. Andy. Thanks, bro. Appreciate you. All right, we just talked with Austin, 25 years old, just graduated from Arizona State, and he made a great point. A lot of these people, when they're 25, 26 years old, they want to purchase a home. You still want to live with roommates at that point? That's great. You buy a 3-bedroom property, you have 2 or 3 roommates, they pay the mortgage for you, you're already a step ahead than most people are at early home ownership. So I'm here with Rob and Kylie. I'm Mike. It's very nice to meet you guys. So are you guys current homeowners?
Yeah.
Okay. So the first home that you bought, do you remember what your interest rate was when you purchased it?
That'd be 7%.
Yes, on both sides.
7%. And when did you purchase that home?
That was, way back.
1996.
Okay, 1996. This is a perfect example that goes to show us that people think interest rates are crazy right now because they're 6.5%, 7%. But you guys have probably seen everything in that time period, right? 7% was probably low when you guys purchased, right?
Oh, yeah.
What would you guys, if you had one tip to give to young college students looking to save, looking to get into their first home, one tip, what would it be?
Save for that down payment.
Yep.
Number one. And always hunt for the best interest rate, because what everyone tells you is not going to be the same as someone else.
Awesome. Great tips. Thank you guys. I appreciate it. Thank you guys so much. All right, guys. So we talked to a few people so far, and the main point of conversation so far has been down payment, saving for that down payment. I will say that's probably one of the biggest misconceptions I get when trying to approve someone for a mortgage. Everyone thinks you need at least 20% down for a down payment. Not true. 20% is best case scenario. Of course, you don't have that private mortgage insurance, but you need 3 to 5% down for a down payment. Now, still, that adds up, and on top of that down payment, you need closing costs and everything included. $300,000 property, you're looking between $12,000 and $15,000, but that big misconception is that you need a lot of money for a down payment. All right, we've talked about the basics of home ownership, stuff that I would have done a little bit differently when I was in college, saved up for that down payment, made sure my credit score was on point, make sure I didn't have a lot of debt. But I really wish that I knew some of the outside of the box programs as well. For example, you could do a fix and flip. If I was in college and I had some friends that were always handy, We're getting yelled at from the sidelines here, guys. Some of these investor programs that they have, for example, a great program that we have for investors is called a 203K loan. With this program specifically, you could buy a property and maybe you need to fix up the property a little bit. We could actually finance some of the work that needs to be done for the property. So not only do I wish that I knew I had to save up for a down payment, I had to fix my credit score, but there's a lot more of outside the box programs. I wish I had talked to someone when I was young, way before I was ready to even be prepared to buy my first home, just so I had some ideas of how I could structure my finances for the future. So man, old stomping grounds brings back a lot of memories being back down here. I'll tell you, the amount of money that I spent at these bars down here, I could have put a down payment on several properties. Would I take it back? Absolutely not. All right, guys, we just got a little workout in while we were out here. Walked up a mountain, saw a beautiful sunset here. We did interview a few people, and one of the biggest questions that I got was, is it a good time to buy? Now, I know being in the mortgage business, everyone thinks I'm automatically going to tell them it's a good time to buy. I'm going to be a salesman. It's automatically a good time to buy, but that's not the case. I have a fiduciary duty to my clients to go through their finances and figure out when and if it's a good time to buy. Having said that, if it's just from a market standpoint, I'm going to use one of those cheesy lines. Time in the market is always better than timing the market. What I mean by that is get in, purchase. Historical averages show that your house is going to gain equity. You're going to make money by being a homeowner. You're going to be paying your own mortgage instead of paying someone else's rent. So I always say, if your finances are in order, if your credit's in order, if you got everything in line, which is something that we're going to talk about and go through, it's always a good time to buy. Mike the Mortgage Guy out.